Welcome to Ezika Academy YouTube channel. In this lecture, I will examine the double entry and the ledgers. If you are coming across my lecture for the first time, please like the video, share it with others, and subscribe so that you don't miss my upcoming videos. To my returning subscribers, I say thank you for being part of this channel. The ledgers. Ledger is the principal book of accounts. The principal book of accounts in which individual transactions are recorded separately. Ledger is the principal book of accounts in which individual transactions are recorded separately. The principal book of accounts in which individual transactions are recorded separately. What do we mean by business transactions? Business transactions is any commercial activities that involve the exchange of value in monetary terms. Business transactions are commercial activities that involves exchange of values in monetary terms. So when you exchange one thing with another, with money, that is said to be business transaction. E.g., rent and rates paid by cash, 1,000 naira. This is an example of business transactions. You pay for rent and rates by cash. So this is an example of business transactions. Purchases of goods by check, 20,000 naira, is an example of business transactions. So what are the types of ledger? We are going to categorize ledgers into three. Number one, we have general ledgers. General ledgers. Number two, we have personal ledgers. Personal ledgers. Number three, we have private ledgers. The real ledger is the ledger for tangible assets. Assets that can be seen or touched, such as land and building, furniture and fittings, motor vehicles, etc. That is real ledger. We have land and building, real ledger. Plant and machinery, motor vehicles, furniture and fittings, etc. So we use real ledger to record the tangible assets or tangible items. On the other hand, we have nominal ledger. Nominal ledger is used for recording the income and expenses of the business. Nominal ledger. So it is used for recording income or gains and expenses or expenditure of the business. We use nominal ledger for recording income and expenses of the business. Income include discount received, rent, rental income, commission income or commission received, investment income, etc. On the other hand, expenses include salaries and wages, rent and rates, insurance, carriage out to us, carriage, etc. Transport expenses, advertisement expenses, etc. Number 2 ledger we are going to examine is personal ledger. Personal ledger. This type of ledger is used for recording the personal accounts items. We use it for recording personal accounts items. It is used for recording the receivables and payables. That means the personal ledger comprises the receivable ledgers, receivables, that is your debtors ledger, and payables ledgers, that is creditors ledgers. So, then we also have private ledger. Private ledger. This type of ledger is used for recording the capital and drawings of the business. The fundamental principles of accounts is the principles of double entry. So, if you want to have a solid foundation in accounting, you must have a sound knowledge of the principles of double entry. Double entry. So, as the name implies, double. The word double means two. So, the art of keeping the two false effects of accounts is known as the double entry. Double entry is the art of keeping the two false effects of accounts. What does this mean? The transactions in accounting will be recorded in two different books. The principles of double entry says that double entry principle states that for every debit entry, there must be a corresponding credit entry and vice versa. For every debit entry, there must be a corresponding credit entry and vice versa. That is the principles of double entry. What does this statement mean? A transaction in accounts will be recorded in two separate ledgers. One transaction, you are going to keep it, you are going to record it in two separate ledgers in line with the principles of double entry. So, for every debit entry, there must be a corresponding credit entry. In line with the principle, I've told you that a business transaction is anything that involves exchange of value in monetary terms. I've given you an example earlier that rent and rates paid by cash. I told you this is an example of business transaction, 1,000 naira. So, in accounting, there are always two sides. The left-hand side and the right-hand side. The left-hand side is called the debit side. Debit, the word debit in account is different from debt. Debit means the left-hand side. Left-hand side of account. While credit side means the right-hand side of account. Right-hand side. So don't confuse these expressions, these terms with their English meaning. In English, we can say credit means giving someone the permission to pay for the goods bought now at a future date. But that is not the meaning in line with their usage in accounting. Credit side means the right-hand side. This is an account. This is the left-hand side. And this left-hand side is called the debit side. Debit side. And that debit side will be abbreviated as DR. Then the right-hand side will be abbreviated as CR, credit side. This is the right-hand side, otherwise known as credit side. So, but in line with the double entry principles, I've told you that transactions will be recorded in accounts in line with the principles of double entry. So, and double entry principle states that for every debit entry, there must be a corresponding credit entry. So in line with that principle, when you see a transaction, that transaction alone, one transaction in account will be recorded in two separate books. Double entry, two entry for one transaction. Now this is the transaction. And this transaction alone will be recorded in two separate books. Now the transaction is rent paid by cash. What are the accounts you are going to keep here? Rent and rates paid by cash. So what did you pay for? You pay for rent and rates. So meaning that this transaction will be recorded, the sum of 1,000 will be recorded in rent and rates accounts. By what means did you pay for this transaction? The payment was made by cash. So it will also affect cash accounts. So you are also going to record the sum of 1,000 naira in cash accounts. Therefore, the two accounts affected, number one is rent and rates account, number two, cash accounts. So, having known that this transaction will affect two accounts, the double entry principles will debit the receiver. Debit the receiver. The receiver is the account or the person who receives the value. The account that take in the value. That is the receiver. Then you credit the giver. Credit the giver. The account or the person that take out the value. Something that take it out. Something that is going out. So you credit it. If it is going out, that is the giver, you credit it. Now when you look at this transaction, for example, we say it will affect rent and rates accounts and cash accounts. You ask yourself, which one receives out of the two accounts and which one gives? Rent and rate paid by cash. So when you are paying for what? You are paying for rent and rates. And when you are making the payments, then you are paying by what means? By cash. That means you are giving out cash in payment. Since you are giving out cash, cash is going out. While rent and rate is coming in. You are paying for rent and rates. So these arrows shows that cash is leaving the business and rent is coming in. So in that case, we have said earlier that you are going to credit the giver, then you debit the receiver. So I want you can sing this in a song-like manner. Debit the receiver, credit the giver. 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 So you sing it in a song-like manner so that you don't forget the principles. That is the fundamental principles of account. In this case, since this affects rent and rates and cash, you are going to open rent and rates account. You open rent and rates account. This is the debit side of rent and rates, and this is the credit side of rent and rates. You put your naira sign. Then you also open cash accounts. Cash accounts. This is the debit side of cash accounts, and this is the credit side. You also put your naira sign. Now, when you pay for rent and rates, cash is going out of the business. So that means you are going to credit cash account. This is the cash account. You put 1,000 at the credit side of cash account because cash is going out. Cash is the giver. The rent and rate that is coming into the business, that is receiving the value, you debit it. So you debit 1,000 to rent and rate accounts. So now it doesn't make sense seeing 1,000 naira here. You know that you have rent and rate accounts. So for reference purpose, where would the corresponding credit entry goes to? You now put the title of the second account here. The second account, notice is rent and rate account. The second account affected is cash accounts. So that means somebody who sees rent and rate account and see cash of 1,000, we know that the corresponding credit entry is in the cash accounts. Then in your cash account, you also put rent and rate account. Somebody who sees rent and rates of 1,000 at the credit side of cash account, we know that the debit entry is in the rent and rates account. Please bear this in mind. I will still take a comprehensive work example in this video. I will also solve examination question as work example. Then I will still extract to extra balance. Please keep watching. Watch it to the end for better understanding. Now let me give you another transaction for illustrative purpose. Bought goods by check 10,000 naira. Here, the word bought means purchases. Bought means purchases. Now, I've told you that a single transaction will affect two accounts. When you see a transaction, the first thing you ask yourself is, what are the two accounts affected by this transaction? So, if you look at this now, what happens here? You are making some purchase. So that means automatically this will affect purchases accounts. Since you are making a purchase, to affect purchases account. By what means? That means you are going to record 10,000 naira in the purchases account because the value of the goods bought is 10,000 naira. By what means were the goods purchased, paid for? It was paid by check. Check note is presented by the bank. So as a result of that, anytime you see check, no, it will affect bank. So you are going to have bank account. We are going to record the sum of 10,000 naira into the bank accounts. These are the two accounts affected. When goods are bought by check, we said it will affect the purchases accounts and the bank accounts. Then you ask yourself, the double entry principle, we debit the receiver, credit the giver. When this goods is bought, which of the two accounts receives the value? If this is one account and this is the second one, which one receives it and which one gives out? When goods are bought, you are given out check in payment. That means the money is going out of your bank account. Since you are issuing check in payment for the goods bought, so in that case, the money is going out of the bank account. So bank is going out. Then the goods is coming in form of purchases. So the giver is the bank, while purchases is the receiver. So you open purchases account, purchases accounts. You also open the bank accounts, bank accounts, bank accounts. Debit side, credit side, credit side, debit side. Now, we said bank is given because money is going out of the bank. You credit bank account, 10,000. You now debit purchases account, 10,000. In your narration here, the name of the title of the other account will be written. So you have bank account. Then in your bank account, the debit entry is in the purchase account. So you put purchases accounts. So that is how that transactions will be recorded. So now let me give you another scenario. Bought goods bought goods on credit. Bought goods on credit from Daudu. 5,000 naira. Bought goods on credit from Daudu. That means when these goods were purchased, it have not been paid for. So what happens here? Goods were bought. That means there is what? Purchases. One of the accounts affected will be, number one account is purchase account, the sum of 5,000 naira. From whom is this goods bought? From Daudu. The second account is Daudu account with the sum of 5,000 naira. So these are the two accounts affected. So you open purchases account, then you open Daudu accounts. So purchases is receiving the goods, while Daudu is giving out the goods. Since the goods were bought from Daudu, Daudu is the giver. And in line with the double entry principle, we credit the giver. So you are going to credit Daudu account with 5,000. Then you debit purchases account with the sum of 5,000. So in purchases account, you now put the name of the other account, which is Daudu. While in Daudu account, you put purchases for reference purposes. This is how transactions are recorded in line with the double entry principle. Please keep watching. You can access all my videos by searching for playlist on the relevant subject. This is financial accounting video. So if you search for Ezekan financial accounting playlist, you type this word or this phrase or sentence at the search menu of your YouTube app. Then if you search for this, Then you will see all the videos I have on financial accounting in a single place. Instead of you having them scattered all over the internet, you'll be able to access them in a single spot. Now, before I take a comprehensive work example, let me examine trial balance. I have a video on trial balance already. So, because the question I'm about to use as work example in this video will also involve the extraction of trial balance. So that is why I still want to talk about trial balance. After your transactions have been posted to ledger, you are going to balance your ledger. Then your ledger, some of the ledgers may be having debit balances, and some may be having credit balances. So you are now going to extract the debit balances and the credit balances. You put the debit balances you've extracted from the ledger, you put them at the debit side of your trial balance, and the credit balances you've extracted from the ledger, you put them at the credit side of your trial balance. So the list of all the debit and credit balances extracted from ledger is known as the trial balance. Therefore, trial balance is the list of the debit and credit balances extracted from the ledgers. The essence of that is to prove the arithmetic accuracies of the ledger. That means the purpose of extracting the trial balance is to prove the arithmetic accuracies of the ledger. So trial balance only shows that you have complied with the double entry principles in recording. That is, you've recorded your transaction at both the debit and credit. Because if you have debited your transactions where those ones that are supposed to be debited, you debit them. Those that are supposed to be credited, you credit them. When you extract your trial balance, the debit side of the trial balance must agree with the credit side of the trial balance. It will balance. So it shows that you are arithmetically correct. But accuracy of the trial balance does not guarantee 100% correctness. It only shows that you have complied with double entry. As you are posting the same amount at the debit side, you are equally doing the same thing at the credit side. That is what your trial balance shows. That is why there are a number of errors you might have committed which your trial balance will fail to agree. And these have been considered in my earlier video on trial balance. Errors such as errors of omission, errors of commission, errors of principles, errors of original entry, compensating errors, and complete reversals of entry. I've considered these errors in my earlier videos, even on my videos on suspense accounts and errors. Example, John Adulam entered into the following financial transactions for October 2022 in respect of his new business, Adulam Electronics, for the repairs of electronic equipment. October 1st, John Adulam invests 800,000 naira in the new business. October 2nd, purchase the following assets for cash. Inventory of materials, 120,000 naira. Loose tools, 240,000 naira. October 3rd, acquired a fairly used motor van for 1 million naira from Evan Motors, paying 200,000 naira immediately. And the balance to be paid later in 5 equal installments. October 4th, paid rent of 120,000 naira. October 5th, received 100,000 naira as payments for repair services. October 6th, repairs of 220,000 naira, and the customers will pay later. October 7th, The first of the 5 installment payments of 160,000 naira is made in respect of the motor van acquired in October 3rd. On the 8th of October, additional loose tools of 20,000 naira were acquired from Ahmed Enterprises on credit. On the 9th of October, paid electricity bill of 10,000 naira. On the 10th of October, received cash of 180,000 naira in respect of October 6 transactions. On the 11th of October, withdraw 40,000 naira for personal use. On the 12th of October, paid transport fare of 2,500 naira. You are required to prepare the cash book and the ledger accounts to reflect the above transactions in the books of the business and extra the trial balance for the month of October 2020. This is an ATS 2 September 2023 question. Solution. In the ledger of John Adulam John Adulam Electronics. So now let's have the cash book. Cash book. So we have date, particulars or details, folio, cash, date, particulars, folio, and cash. We are keeping a single column cash book. I've told you may either put cash or you put amount. The reason for keeping a single column cash book is because all the transactions are in cash. They are two placed by cash. So that is why we only put cash, no bank. There is no transactions that take place by check. Now back to the question. October 1st, John Adulam invests 800,000 naira in the new business. Since he invested the sum of 800 naira into the business, he is putting in the sum of 800,000 naira into the business. The business is receiving it in form of capital. So the money used to start the business is called capital. So this transaction will affect the cash. Since he's putting in cash into the business, it will affect cash accounts. At the same time, it will affect the capital account. Remember, the money used to start the business is called capital. So the cash is what is put into the business. So you debit the cash account because cash is received, then capital gives. So debit cash account and credit capital account. That is October 1st. This is cash account. October 1st. So the amount is 800,000 naira. The cash put into the business is 800,000. So you debit cash account. Then in your narration here, you put capital account. Then you open a capital account. Remember, in line with the principles of double entry, for every debit entry, there must be a corresponding credit entry. So in this case, no capital gives out. So we are going to credit the capital account. Since the debit entry is in the cash account, the corresponding credit entry will be in the capital account. October 1st, 800,000 naira. So your narration here, you put cash. It doesn't mean you are crediting cash. No, it is the title of the account that has been credited. So it is the capital account that has been credited, not cash. So the cash account has been debited here, while capital account has been credited. Back to the question. So we have October 2nd. Purchase the following assets for cash. You purchase an asset, you purchase inventory, you also purchase loose tools. You buy them by cash. So when you purchase, you are giving out cash. What you are giving out is cash account, is cash. So therefore, cash account will be credited and this account will be debited. Inventory and loose tools account will be debited. Remember, purchase are goods bought for receipts. So it will be wrong. You record this as purchase. If you record this as purchase, you have committed the error known as errors of principles. Know the primary business of Adolam Electronics is on the electronics materials. So the inventory bought, so you are going to record it as inventory, while the loose tools, you equally record that as a loose tools. Please take note of that. So now you are giving out cash. Cash is going out. Since cash is going out, you credit cash accounts. Then you debit these two accounts. Now, inventory, 120,000. Loose tools, 40,000 on October 2nd. October 2nd, October 2nd. Purchase of inventory by cash of 120,000 naira. Then the same October 2nd, loose tools, and that amounted to 240,000 naira. 240,000 naira. So you are going to open a ledger for inventory and loose tools. Now let's open the inventory accounts. Inventory accounts. Since cash account has been credited, that means you are going to debit the inventory account in line with the principles of double entry. October 2nd. So cash. The value of the inventory is 120,000 naira. Then you also open loose tools account. Loose tools accounts. It has been credited to cash account. So you debit the loose tools account. October 2nd, cash, 240,000. So you debit the loose tools account. Cash account has been credited. Back to the question. On October 3rd, acquired a fairly used motor van for 1 million naira from Evans Motor, paying 200,000 naira immediately. So you are going to open the motor van account and Evans Motor account. You purchase a motor van. Motor van is an asset from Evans Motor. Evans Motors is the giver. So the two accounts affected are motor van account and Evans Motor. The seller is Evans Motor. Remember, in line with the principle of double entry, we credit the giver. So that means you are going to credit this one. It is going out of this. Then it is coming into motor van. So Evans Motor, the giver, you credit Evans Motor, you debit the motor van. Now let's open ledger accounts for them. So now let's have motor van accounts. Then let's also open Evans Motor accounts. Evans Motor is the seller. Evans Motor is the giver, the one that give out the motor van. And the business receives the motor van. So you debit the motor van account and you credit Evans Motor. October 3rd, Evans Motor. The value of the motor is 1 million. Then you credit Evans Motor. October 3rd, motor van, 1 million naira. Back to the question. The same October 3rd, paying 200,000 naira immediately. He pays 200,000 naira immediately, and the balance will be paid later. The 200,000, that means the business is paying the sum of 200,000 naira. The business is giving out cash. So cash is what the business is giving out. And he is paying this cash to Evans Motor. Evans Motor is the one receiving that cash. So in this case, you debit the receiver, which is Evans Motor, and you credit cash with the sum of 200,000. October 3rd. October 3rd, we have Evans Motor, the sum of 200,000. So you debit Evans Motor, which is the receiver. October 3rd. So you have cash. The amount paid is 200,000. Then back to the question. On the 4th of October, you paid rent of 120,000 naira. Rent of 120,000 naira was paid. So that means cash is going out of the entity. Cash is going out. Cash is going out. Then you are paying for rent. This affects both the rent account and cash account. Since cash is going out, cash is the giver. You credit cash account and you debit rent account. So October 4th. October 4th. So we have rent, the sum of 120,000 naira. So you are going to debit the rent accounts. Rent accounts. Rent accounts. Since cash account has been credited, we are therefore going to debit the rent account with the sum of 140,000 naira, which is October 4th. October 4th, we have cash, and the amount is 120,000 naira, being the corresponding entry for this rent paid of 120,000 naira. Back to the question. We have October 5th, received 100,000 naira as payment for service for repair service. No repairs, that is part of their service. So you receive money. That means you are receiving cash for repairs. Cash is what you receive. So you debit cash. Cash comes in. Then repairs for service is the giver. So you credit repairs and revenue account. So you receive the sum of 100,000 naira. So you debit cash account, which is October 5th. October 5th. You have service revenue. The amount received is 100,000 naira. 100,000 naira. Then let's open the service revenue account. Service revenue accounts. So we are going to credit service revenue accounts with the same amount, which is October 5th. Cash 100,000 naira. Repairs of 220,000 naira, and the customers will pay later. Repairs of 220,000 is also a revenue to the business, and these have not been paid. No cash is involved, so that means it will not pass through the cash book. So repairs revenue account will be affected. Repairs revenue is an income, so which is the giver. Customers is a debtor, receivables there. We are going to record it in the receivables account. So let's open receivables account. Receivables. accounts. Receivables account, October 6th. So we have service revenue. The amount involved is 220,000 naira. So you are going to credit service revenue October 6th. So we have receivables 220,000 naira. October 7th, the first of the 5 installment payments of 160,000 naira is made in respect of the motor van acquired in October 3rd. Remember, in October 3rd, on the 3rd of October, a motor van was bought from Evans Motor, and after the first deposit, the rest of the payments are to be made in 5 equal installments. And now the payment of installments is to be made. So since the installment is to be paid now, it is going to be paid to Evans Motor. Evans Motor becomes the receiver, and the cash is going out of the entity. Cash is going out of the business. So cash is the giver, while Evans Motor becomes the receiver. So in that case, you are going to credit cash account and you debit the Evans Motor account. So October 7th. So you have 7th of October, Evans Motor. Amount paid is 160,000 naira. 160,000 naira. You are equally going to debit Evans Motor account. So Evans Motor is the receiver on the 7th of October. So you have cash. Amount paid is 160,000 naira. Back to the question. So on the 8th of October, additional loose tools of 20,000 naira were acquired from Ahmed Enterprises on credit. So in this case, the parties involved, we have the loose tools, which was acquired, and it was bought from Ahmed Enterprises. Since it was bought on credit, no cash is involved. Since there is no cash involved, it will not pass through the cash book. So the accounts affected in this case is Ahmed Enterprises and the loose tools account. We've opened a loose tools account earlier. So now additional loose tools of these were acquired from Ahmed Enterprises. Ahmed Enterprises is the giver. So since it is going out of Ahmed Enterprises, the one giving out the loose tools. So you credit Ahmed Enterprises, you now debit loose tools account. So now let's open a ledger for Ahmed. Ahmed Enterprises accounts. You have the debit side and the credit side. Ahmed Enterprises is the giver, so you credit Ahmed Enterprises. That is October 8th. So we credit Ahmed Enterprises with the sum of 20,000. The narration will be loose tools. Loose tools. So you are going to debit loose tools account. Haven't credited Ahmed Enterprises, so we debit loose tools accounts. So our loose tools account, this is the loose tools account. So October 8th, we have Ahmed Enterprises. The amount involved is 20,000 naira. Back to the question. On the 9th of October, paid electricity bill of 10,000 naira. Electricity bill of 10,000 naira was paid on the 9th of October. So the accounts affected is cash, because cash is going out of the entity. Cash is going out. So that means you are going to credit cash account, then you debit electricity bill account. So let's open electricity bill account. Electricity B accounts. So we have the debit side and the credit side. So the cash is going out. You are going to credit cash account. You debit the electricity bills account on the 9th of October. So we have cash of 10,000 naira. So we are going to credit the electricity bills account on the 9th of October. October 9, we have cash. The amount involved is 10,000 naira. 10,000 naira. Back to the question. On the 10th of October, you receive cash of 180,000 naira in respect of October 6 transaction. Cash of 180,000 naira was received in respect of October 6 transaction. The transaction which took place on the 6th of October is repairs of 220,000 and the customers will pay later. Now that customer you are receiving the sum of 180,000 naira from him on the 10th of October. So now cash is what you receive. October 9th, you receive cash of 180,000 naira from that customer. 180,000 naira from the customer in respect of October 6th transaction, and that customer is receivables account. So you are going to credit receivables account now. Let's credit receivables, which is October 9. October 9, on the 9th of October, we have cash. The amount received is 180,000 naira. The date of the transaction is 10. So that is when the sum of 180,000 naira was received. Back to the question. Then we drew 40,000 naira for personal use. Anything taken out of the business for personal use is called drawings. Drawings, when you withdraw anything from the business for personal use, we call it drawings. So this transaction we have fetched drawings account, and you are withdrawing cash. We drew 40,000 naira for personal use. That means cash is going out of the entity. Cash is going out. So you credit cash account, you debit drawings account. Let's open drawings account. Drawings account. So on the October 11th, so we have cash. You are debiting drawing with the sum of 40,000 naira. You debit drawing with 40,000 and you credit cash with the same amount. On the 11th of October, so you have drawings. The amount involved is 40,000 naira. 40,000 naira. Back to the question. On the 12th of October, paid transport fare of 2,500. You pay transport fare. So cash is going out of the entity. Cash is going out of the business. So we are going to credit the cash account and we debit the transport expenses account. Transport expenses accounts. Debit transport. You credit cash. Cash is going out. Since cash is going out, you are going to credit cash account. You debit the transport account. So which is October 12th. So you debit transport with 2,500. So you credit cash. Cash with 2,500. That is October 12th. So you put transport. The amount involved is 2,500. Back to the question. You are required to prepare the cash book and the ledger accounts to reflect the above transactions in the books of the business and extract the trial balance for the month of October 2022. The next thing is to balance the accounts. Now, let's balance the account. The debit side, 800,000 plus 100,000, that is 900,000, plus 180,000, which is 1,080,000 naira. The credit side, let's sum it up. 120,000 plus 240,000, 240,000 plus 200,000 plus 120,000 plus 160,000 plus 10,000 plus 40,000 plus 25. The credit side is totaled 892,500, and the debit side is totaled 1,080,000 naira. 1,080,000. That is the total of the debit side. And the credit side is totaled 892,500. So if you subtract it from 1,080,000, you have the difference of 187,500. The last day in the month of October is 31st. So you have balance carried down. So the difference is 187,500. So 1,080,000 is the total. Your balance carried down will be brought down to the next period. After October, we have November 1st. November 1st. November 1st, balance brought down. The difference here, 187,500. So you have it here, 187,500. So capital account, you only have capital account there. So you can close it like this, or you come here. The last day of the month of October, October 31st, balance carried down, which is 800,000 naira. So you can do the same thing here, but since we have only this, let me just double strike it. Then the lose-lose account. If you sum up this, you have 260,000. 260,000. Then the last day in the month of October, October 31st, balance carried down, 260,000. In the same line with this total here, we are going to have 260,000. After October, you brought it down to the next period, November 1st, balance brought down 260,000. Then you close your motor van account. Let's close this. Credit side, you have 1 million naira. If you add this up, it will be 360,000. The last day in the month of October, 31st, balance carried down. Subtract 360,000 from 1 million. 1 million naira minus 360,000. Then you have the difference of 640,000. 640,000. Then total is 1 million. Then 1 million. So the closing balance here will be brought down November 1st. Balance brought down, which is 640,000. 640,000. Then Ahmed Enterprises, let's close it. Electricity bills, then drawings, transport, rent accounts, let's close that. Then we also have service revenue accounts. If you add 100,000 to 20,000, that will be 20,000. The last day in the month of October, October 31st, balance carried down. That is 320,000 naira. So the same level with this, 320,000 naira. After October, we have November 1st, balance brought down, which is 320,000 naira. After October, we have receivables account. The debit side, we have 220,000 and 180,000 at the credit side. In order to agree the two sides, you have October 31st, balance carried down. The difference between 220,000 and 180,000 is 40,000. 40,000. So the total is 220,000. Then 220,000. After October, we have November 1st, balance brought down, which is 40,000. Now, let's extract a trial balance for John Adulam Electronics. John Adulam Electronics. Trial balance as at October 31st. October 31st. Which year? So I've rubbed up the beginning of the question. So you have to put the year 2022. So we have the debit side of the trial balance and the credit side. This is the debit side and this is credit side. Now, we have rent account, the sum of 120,000. So it's a debit balance. So you put rent, 120,000. We inserted the 120,000 at the debit side because this rent is a debit balance. Then service revenue account, the 320,000 is a credit balance. So we are going to insert this 320,000 at the credit side. So service revenue, 320,000, credit balance. Then we also have receivables. This is a debit balance of 40,000 naira in receivables accounts. So you are going to put it at the debit side. Receivables, 40,000 naira. 40,000 naira. Then we have Ahmed Electronics, and we have credit balance of 20,000 in Ahmed Electronics. So Ahmed Electronics, credit balance of 20,000 naira. We also have electricity bills, 10,000 debit balance. Electricity, 10,000 debit balance. Then we have drawings, 40,000 debit balance. Drawings, 40,000 naira debit. Then we have transport expenses, debit balance of 2,500. Transport expense, 2,500. We have cash book, which the debit balance of 187,500 cash. $187,500. Then we have capital, credit balance. This is carried down, so it is going to be brought down to the next period. Balance brought down 800,000. Capital is having a credit balance of 800,000 naira. Capital. $800,000. Then we have inventory, a debit balance of 120,000 naira. Inventory, debit balance of 120,000. Then we have loose tools, a debit balance of 260,000 naira in loose account. Loose tools, debit balance of 260,000. Then we have motor van, debit balance of 1 million. Motor van, ₦1 million. Then we have Evans Motor. Evans Motor, a credit balance of 640,000 naira. This 640,000 is what was brought down here. Credit balance of 640,000. Evans Motor, 640,000. So you now sum up the debit side and the credit side total. Now, from the beginning, John Adulan Electronics trial balance. So 120,000 plus 40,000 plus 10,000 plus 40,000 plus 2,500 plus 187,500 plus 120,000 plus 260,000 plus 1 million naira. The total of the debit side is 1,780,000. 1,780,000. Now, the credit side, we have 320,000 plus 20,000 plus 800,000 plus 640,000. The total is 1,780,000. So our trial balance agreed. Since we have the same amount at the sum of the debit and credit side. This is the end of the solution to the question. Please don't forget to like the video, share it with others, and subscribe. Thanks for watching AZK.